Visa was down 21.3% in the last few months. Joseph Carlson sold his Visa stock and I doubled my position in Visa. Let me show you why. Visa had a very good quarter and still they dropped like a stone. Now, why is an excellent company such as Visa down 21% in the last few months? I mean, their revenue growth is amazing, so are their profits, and so is their dividend growth. I wanted to get to the bottom of this, so I made a deep dive into Visa. What is going on and if I still believe in the future of Visa. Let me take you on that journey. One of the most heard threats to Visa's business model is buy now, pay later, or BNPL. And for good reason, just look at the growth trend of buy now, pay later transactions, which is only accelerated by the global pandemic. Not surprisingly, millennials and Gen Z generations are the front runners for BNPL transactions. Visa addressed this threat in their most recent earnings call. In the short term, Visa states that many of these players actually use them, Visa, and their credentials, whether it's virtual cards, debit or credit cards. And with buy now pay later, instead of one payment, 4 payments are made, which is generally good for a company like Visa that receives a percentage of each transaction. Longer term, Visa believes these BNPL providers will hit a wall as they can't scale up quick enough. The expectation is that BNPL providers will actually become issuers of Visa credentials, which will be baked into their value proposition, which will give them instant scale as they will have access to over 100 million merchants that are already part of the Visa network. As if the threat of buy now pay later is not already enough to potentially disrupt a business like Visa, there's yet another threat looming. This video is sponsored by Freedom24, a European broker that allows you to buy stocks on all the big exchanges, offers a 3% yield on their bank accounts, and allows you to easily get in on IPOs. Get your free stock worth up to $600 by clicking on the link in the description. Back to the scheduled programming. And that is the threat of open banking and digital banking. Open banking basically allows third parties to access financial data through integrations with the traditional banks. This makes it easier for consumers to securely share financial data with other financial institutions, making it easier to switch banks or apply for a mortgage, for example. This sparks innovation and brings new players to the market. Players that could be a threat to the traditional payment processing players like Visa. To make matters worse for Visa, their deal with one of those new players, Plaid, fell through, because the DOJ blocked it for antitrust issues. However, Visa believes there is still a place for them in the open banking system. They are actively leaning in with these new players to see where they can provide value. For example, taking care that transactions are done securely or to offer other tools such as disputing a payment and so on. That is also why Visa has Visa Direct, which is part of the network of network strategy, where a payment might not go fully through their network, but Visa makes sure the payment gets from A to B in real time, whether it's business to consumer or sending money to a loved one on the other side of the world. On the open banking front, they also have the acquisition of Tink pending in Europe. So instead of a US player, they are now looking at the European player to acquire in this space. Joseph Carlson mentioned that players like Square and PayPal are a threat to Visa's business.
And I don't believe that Visa and MasterCard are as much of a monopoly as people think they are. Square, for instance, is growing like crazy. This is a real competitor to Visa. And of course, PayPal is another huge fintech company that's also offering unique value propositions for consumers by bypassing Visa and MasterCard. These are real threats to Visa and MasterCard.
But I beg to differ. These players are in a different part of the payment ecosystem as gateways and facilitators. And the thing is, those payments still go over the Visa payment network or rails. Visa is even under scrutiny from, you guessed it, the Justice Department, for incentivizing these players to use their payment network instead of another network. To me, that sounds like normal business practice. Investigations from regulatory bodies is nothing new to Visa, and it is a clear sign of their dominance. Just look at other industries where the likes of Facebook, Apple and Google are facing the same kind of attention from regulatory bodies. And if this wasn't enough, we also have crypto, another potential game changer. Actually, it is already changing the game, so not much potential but a real threat. In the last few years, Visa has jumped on the crypto bandwagon by partnering with over 50 crypto partners. For example, the Crypto.com Visa card was introduced, enabling people to quickly access their crypto funds. Crypto also has an issue that Visa is proposing a solution for, the interoperability problem. Right now, most blockchain ledgers operate in silos, making it difficult to transact between those ledgers. Visa is proposing a universal payment channel, which would of course put them right in the middle. We also have the merchants, of which some are complaining about the fees that Visa charges for their transactions.
But Visa's success hasn't always been great news for merchants who have no choice but to rely on them for payment.
If I could ask Visa for one thing, it would be for relief in the swipe fee arena. We are paying way too much.
Among those merchants are some big players. Amazon is no longer accepting Visa credit cards in the UK because they are tired of the fees. And if Amazon is mentioned, stocks for some reason tend to drop. And to top it all off, Visa softened its guidance to a growth rate in the mid-teens, instead of the expected high-teen, 18 to 19% growth rates. Is that so strange though? We are still in the midst of this health crisis and a lot of things are still uncertain. So Visa erring on the side of caution sounds reasonable to me. And you know what? I get it, the sell-off. I mean, just look at all these threats. It is like there's no future for Visa. But Visa is a company of innovation. The name Visa was born in 1976, after it was first named Bank Americard from Bank of America. During those years they have been at the forefront of innovation, and even now with partnerships with several other promising fintech companies such as Chime, Airwallex and much more. One of the main points that Joseph Carlson brings up is that he feels Visa has not been innovative enough for consumers in the last decade to warrant high transaction fees. The reason why Amazon will drop Visa credit cards in the UK.
Have you noticed any significant value add from Visa in the last decade? I haven't. I have a hard time thinking of any type of value add from either of these companies. When I looked at this debate further, I found myself agreeing with Amazon.
I understand that, because most of Visa's technologies act under the radar as an enabler for other companies to innovate. One example of this is the Visa token service, which makes sure the growing mobile payments industry can make payments securely, but there also seems to be a general misunderstanding amongst a lot of people what Visa actually does and how they make money. So let's take a look at that. First of all, Visa is not a credit card company. They are a payment network. The cards are issued by the banks. Visa makes money in a few different ways. The lion's share of their revenue comes from service revenue, which comes from earning a small fee on each transaction. Data processing revenue is also a big part of their revenue, and that includes revenue earned from authorization, clearing, settlement and other value-added services such as security and fraud protection. International transaction revenues are earned for cross-border transaction processing and currency conversion activities. This segment obviously took a big hit when international travel went down. Other revenues are earned for value-added services and license fees for the use of the Visa brand or technology. And just look at those margins. This means they get to keep almost 50% of each dollar they earn in revenue. That is incredible. As a dividend investor, Visa is not really a company that looks exciting at first with a 0.7% yield. But they do have a 5-year dividend growth rate of almost 18%. And they also return value to shareholders by consistently buying back shares. I do have something to confess though. I said at the beginning of the video I doubled my position. Which I did, but from 1 to 2.25 shares. Anyway, if you still believe me after misleading you like that, let's see if Visa is also buying opportunity from a value point. Looking at fast graphs, the price is still above the blue line, the price Visa has been historically valued at by the market. But there could be a 13.2% annualized return if analyst predictions hold true, which they typically do for Visa. Cross-checking this with another website, Finbox, they give a fair value of $211. So an upside of roughly 7%. With a 5-year average dividend yield at 0.6%, it also looks a bit undervalued from the dividend side. So not a screaming buy, but pretty close or just under fair value. If it stays in this price range or goes lower, I will probably add more. Looking for a higher dividend yield? Then definitely check out this video on average.